Hello everyone. In this particular lecture, we're going to talk about accounting for healthcare organizations. Okay, accounting for healthcare organizations is extremely similar to accounting for colleges and universities that we actually talked about in the prior lecture. So let me show you as an example. So you can see from this slide, accounting for healthcare organizations, just like colleges and universities, they could be either for-profit, basically owned by individual owners or shareholders, if it's a corporate form of business, or most likely they're non-for-profit. And just like with colleges and universities, healthcare organizations could be private nonprofits or governmental or public nonprofits. There are various types of healthcare organizations. We're going to concentrate on hospitals when we go through accounting for healthcare organizations, but I just need you to understand that there are various forms of healthcare organizations above and beyond just hospitals. There's clinics, there's medical group practices, there's individual practitioners, there's retirement communities, there's HMOs, home health agencies, nursing homes, drug and alcohol rehab centers. So you can see they come in different flavors. But for purposes of this chapter, we're most likely going to be concentrating on hospitals. And just like with the colleges and universities lecture, depending if the nonprofit is either governmental or non-governmental, we're going to follow either FASB standards or GASB standards. Obviously, with the private nonprofits, we will follow FASB standards very similar to the way we learned back in the lecture a couple of weeks ago. And if the healthcare organization is a governmental healthcare organization, we will follow GASB standards, very similar to what we learned in the proprietary fund chapter. Basically, the healthcare organization would be considered a business type activity. Okay, so if it is a private healthcare organization, we will have a balance sheet, an operating statement, as well as a cash flow statement, as well as a statement of changes in net assets. It's kind of like a retained earnings statement. And then the GASB, we would have a balance sheet. The name of that would be a statement of net position, an operating statement, and the name for that would be a statement of revenues, expenses, and changes in net position, and a cash flow statement. The FASB cash flow statement has 3 sections: operating, investing, and financing. But as we learned in the proprietary fund chapter, the GASB cash flow statement has 4 sections. It would be operating, investing, capital financing, and non-capital financing. On the balance sheet, the equity section, we would have to know that for a private nonprofit using FASB standards, our equity is called net assets, further broken down into 2 subcategories. That would basically be net assets without donor restrictions, effectively unrestricted, and net assets with donor restrictions, some form of restriction, like a permanent restriction or some sort of use or time restriction. Very similar to what we studied a couple of lectures ago. If the healthcare organization is a governmental nonprofit, equity is going to be called net position. And just like we learned in that proprietary fund chapter, the net position is broken down into 3 subcategories. Basically, we have unrestricted, and then we'll have restricted, and then we'll have net investment in capital assets. And if it's a for-profit healthcare organization, equity would be broken down between capital stock and retained earnings, very similar to the way you learned in your prior for-profit accounting classes. Okay, let me work through a couple of assets, liabilities, some revenues that are pretty unique to the healthcare organization. What you're going to see is that this is very, very similar to colleges and universities. There might be a little bit difference in wording, but the categories are pretty similar. All right, first, there's a category called assets limited as to use. And this is going to be for private nonprofit healthcare organizations. And basically this category, assets limited as to use, are basically assets without donor restrictions. So it's completely unrestricted. However, the use is limited by the governing board or contracts or agreements with outside parties. So it's basically unrestricted in terms of the donor, all right, or the grantor, but the board or some contract that we sign actually limits what we can do with these funds. This would be very similar to when we learned in the proprietary fund chapter. If you recall that GASB statement had an asset called restricted assets on it. That would be the comparison. All right, investments for nonprofits, just like we're going to see here, they're reported at fair value, and basically any unrealized or realized gains and losses are reported as changes in net assets. Effectively, they're reported through the operating statement. And it's the same thing with governmental or GASB standards, where the investment is recorded at fair value, and the change, whether it's unrealized or realized change, would be reported through the operating statement. Receivables is a big deal. This is probably one of the more important items when we're dealing with healthcare organizations. And the reason for that is because we have this third-party payer involved, and that would be the insurance company. I'm going to come back here, but I need to fast forward just for a minute here to kind of give you a visual when the third-party payer is involved. All right, I would imagine most students listening to this have dealt with healthcare in the past, where you, as the patient, did not actually pay. The pay was most likely through your health insurance company. And so what you see here is a visual of the healthcare provider. That would be your doctor. And then you go see the doctor, or you go visit the hospital and are serviced there. And you don't actually get the bill. As you can see in the middle there, between the healthcare provider on the upper left and the insurance company on the upper right, there's a contract. And basically what happens is this. The healthcare provider is going to bill in full. They're going to record revenue for the gross amount. So as an example, let's say they performed a procedure on you, and the full gross amount of that revenue was, let's say, $10,000. However, with the insurance company contract that the healthcare provider signed, there is going to be an agreed upon price for that particular procedure. And basically the healthcare provider, in the contract with the insurance company, there is a very detailed list of all of the potential services that the healthcare provider can provide the patient. And each of those services comes with a fee. So let's say, for an example here, that the gross rate for this particular procedure is $10,000. But in the contract that the healthcare provider signed with the insurance company, let's say in the contract, the insurance company said, we are going to pay you $6,000 for this service. So the journal entry that you are going to see on the hospital, the healthcare provider's records is as follows. The receivable is going to be recorded for $6,000, okay? But the revenue is going to be recorded for a full $10,000. So what's the difference between the net receivable of $6,000, which is the debit, and the revenue of $10,000, which is the credit? The difference is called a contractual adjustment. The contractual adjustment is considered a contra revenue account. And this contractual adjustment is going to be debited for $4,000. As you would imagine, contra revenues, they would always have a debit balance. So that's how it works. And it's very similar, very comparable to what we learned in the prior chapter when we were talking about tuition for a university. If you recall, in that chapter, we talked about the university recording tuition revenue at the gross amount, even if the student doesn't wind up paying all of it because of some scholarship money or whatnot. And then, of course, with the scholarship money or some sort of tuition waiver, we used a contra revenue account. The same thing here, and that will be called a contractual adjustment. So that is very important. And here's the slide that talks about the contractual adjustments. Once again, it is the contra revenue account, the difference between the gross revenue and the agreed upon amount between the healthcare provider and the insurance companies. All right, let me work my way back to where we were. All right, we were over here. So basically, that's what we were talking about, receivables, how they're recorded at the net amount between the gross revenue and the contractual agreement between the provider and the insurance company. All right, now, the receivable, even though it's recorded there, it may not necessarily be collected. So another thing we need to worry about with receivables is the allowance for uncollectible accounts. And a lot of times this happens when we really don't have insurance, but we have a private payer where the patient actually comes to the healthcare provider without insurance and they work out a payment plan. Well, sometimes those payment plans are not effectively followed, and there might become a point in time where the healthcare provider needs to write off the outstanding receivable. So just like a for-profit company would be following the net realizable value of the accounts receivable by recording the appropriate amount in the contra receivable account, the allowance for uncollectible accounts, the healthcare provider would do the same thing. All right, now let's take a look at the operating statements. So revenue, obviously, is a big factor of the operating statement. Healthcare organizations, of course, they have patient service revenues, but they also have revenues from other sources. They might have revenue from rental fees for, as an example, an extended care facility. That would be like an assisted living facility or a nursing home. Maybe they have some revenue from HMOs and the like. They could also have auxiliary revenues, just like a college and university. There would be a cafeteria, there would be a gift shop. These are typical things that you see in a hospital. Unfortunately, I think we've all have either been in the hospital or visited a hospital, and you do see cafeterias and you do see gift shops. You might also see conference rooms, and I do see conference rooms on the usual hospitals. Conference rooms are rented out for people to give medical seminars and the like. I've seen that, and these are all examples of auxiliary revenue. So revenues come from a number of sources. We talked about contractual adjustments. All right, next we want to talk about charity service. All right, now charity service is as follows, and I have to say this is very unique to healthcare providers, especially hospitals. And I don't need to reiterate it to you word for word, but those individuals that pass the medical boards and they become medical doctors, MDs, they take an oath. And basically the oath, and I'm paraphrasing here, the oath basically says that I'm going to help somebody in need whenever I see that they're in a medical need, regardless of their situation. So as an example, say that there is a car accident, a really bad car accident in the middle of the road, and a medical doctor is driving his or her car, and they see the accident, and they clearly see that someone needs immediate medical attention. Well, they took an oath to help the people in that situation immediately. They are not worried about the potential individuals that were hurt. They're not worried about their ability to pay or inability to pay at that moment in time. Well, I got to say the same thing with a hospital. And let's take a look at the first bullet point here. It says both government and non-for-profit healthcare entities. So let's talk about hospitals. they're expected to provide some level of charity care. Now, what charity care is basically services to persons with a demonstrated inability to pay. Now, just because a patient comes in with an inability to pay, they're going to be serviced. So let's go to the example of a homeless person that I would think we would all come to the conclusion that a homeless person has a demonstrated inability to pay. Well, if they come into the emergency room at 3 a.m. and their arm is halfway off their body and they need immediate medical attention, they are going to be serviced. They are not going to be turned away because they have the demonstrated inability to pay. Charity service, and here's the accounting for it, now that I've defined what charity service is. Charity service is never expected to result in an inflow of resources. We never expected to collect. Once we've come to the conclusion that this is a charity case, we don't recognize it as revenue, nor a receivable, nor bad debt. So for accounting purposes, charity care is ignored. All right, and that is very, very important. However, the charity care policies and the level of charity care that we provide, we're going to disclose that in the footnotes to the financial statements. It is something very important for the readers of the financial statements to see. All right, we talked about revenue, or where they all come from. All right, now let's talk about donations. Just like colleges and universities or nonprofits in general, they can get donations from donors. Contributions is another word for that. Same thing with a nonprofit healthcare organization. So let's first talk about not donation of money, but donation of materials. Now, donation of materials, the FASB, so this is the private nonprofit healthcare organization, they require that donated materials are reported at fair value. Okay, and same thing with GASB. Now, the FASB, talking about donated services, just like we talked about a couple of lessons ago, the donation of a service will be reported as a revenue if that service requires a specialized skill and they're provided by individuals that possess those skills, and they typically would be needed anyway if they weren't provided as a donation. If you recall, I gave the example of a CPA donating services to a nonprofit, giving a free audit. Well, that's an example of something that requires a specialized skill and typically would need to be purchased anyway. Now let's look at the GASB. Like we said, GASB, they require donation of materials at fair value, just like FASB. Here's the big difference. Donation of services. Even though there is a donation of services with the FASB that's required to be reported, just like I explained, if it's a special skill that would need to be purchased anyway, the GASB, take a look at the second bullet point here. GASB does not provide for recognition of donated services. So with the GASB, it does not matter whether the service donated was requiring a specialized skill or not. It is simply not recorded. So there's a big difference there. Expenses, accrual accounting, that is a good thing. And the estimates from collectible patient accounts, we will use not a bad debt expense, but healthcare organizations will use a Contra revenue account. All right, so along with all of those explanations, now let's take a look at some very, very typical journal entries that we would see in a healthcare organization. We will be using, we're going to be using a private healthcare organization for this illustration, but just remember that there is a private healthcare organization as well as a public or a governmental healthcare organization. We will study both in this chapter, but for illustration purposes, we're going to concentrate on the private healthcare organizations. Okay, first, the hospital sees patients, and we're just going to record the gross amount, and that's journal entry 1. Debit the receivable, credit revenue. After we record everything at gross and after we take a look back and we decide, out of that amount, there's a few items in there. When we got to taking a look at the detailed health insurance contracts of the patients that provided health insurance to us, we realized that $100,000 of that amount that was billed, we're not going to be able to collect because of the contractual difference between what we billed and what we agreed upon with the insurance contract. So we will basically write down $100,000 of that by debiting the contra revenue contractual adjustment and crediting the receivable. In addition, we've realized that some of that amount was from private payers. And we realized that based on the agreements we're coming to with these private payers, that 180,000 of it, most likely we're going to have a problem collecting. So we will actually increase our allowance for doubtful accounts by debiting the provision for bad debts. Once again, that is a contra revenue account, just like the contractual adjustments are. And we will credit the contra receivable, or the allowance from collectible receivables. All right, so journal entry 1 coupled with 2, obviously there's some uniqueness there with colleges and universities. Journal entry 3, we're just collecting on our other revenue streams like auxiliary revenues like the cafeteria sales, the gift shop sales, and the whatnot. Debit cash, credit revenue. No biggie there. Journal entry 4, we are receiving donations without donor restrictions, basically completely unrestricted. In addition to that, we have received some investment income on our portfolio, also without donor restrictions. Remember, with private nonprofits, every time we have a revenue item, we need to say with or without donor restrictions. All right, journal entry 5, it looks like we sold a piece of equipment that had a original basis of $28,000, had a accumulated depreciation of $26,000, so it had a book value of $2,000, and we sold it for $500. So we sold it for a loss of $1,500. This is nothing new. This is a journal entry that you would learn in your intermediate, actually in your principles class, selling a piece of equipment at a loss. Journal entry 6, we bought new equipment, $400,000. And we had $100,000 of previous donations that were set aside to help buy that equipment. Now that the equipment has been purchased, you can see journal entry 6B is releasing that $100,000 out of restriction. Effectively, that $100,000 is going to go out of the with donor restriction column into the without donor restriction column. Remember, this operating statement has 2 columns. It's really 2 income statements in one. There's a column for without donor restrictions and a column for with donor restrictions. And this basically just moves the $100,000. It's a reclassification from with donor restrictions into the without donor restrictions column. Journal entry 7, all we're doing is accruing our expenses, as you see here. Journal entry 8, we are collecting on our receivables. In addition to collecting on our receivables, we decided to write off an additional $131,000 of receivables that have been reserved for bad debt previously. They're being written off here. At the same time, we're collecting other receivables. Journal entry 9, we're just paying off our bills, debiting the payables, and it looks like we're paying some interest on the mortgage as well. Journal entry 10, it looks like we are utilizing some inventory. Inventory is basically supplies. We're not talking about inventory that we're selling, basically supplies used on patients. I guess you can call it inventory because we are using them on the patients. But anyway, we're debiting the various expenses and we're reducing the inventory with a credit. All right, journal entry 11, all we're doing here is we're reclassifying some of our expenses that we're accruing for expenses. So we're debiting the expenses, we're crediting the accounts payable or the accrued expenses payable. In addition, some of the expenses were previously prepaid, and so we're just reclassifying out of the prepaid expense and into the expense. Journal entry 12 is the normal depreciation journal entry. Hopefully you're seeing these journal entries are pretty easy. You know, besides the first two, which was pretty unique to colleges and universities, the rest of them pretty much flow in normal accrual accounting that you've learned in prior accounting classes. Nothing that big here. Journal entry 13, some investment income was earned. Debit cash, credit investment income. Journal entry 14A and B, they go hand in hand. So 14A, we have some cash that actually, because of some contract that we signed, we've basically said we're limiting this cash to what it could be used for. So we're debiting this new account called Assets Limited as to Use, and we're setting it aside in an investment account, and we're crediting cash. And because we use that money for what the donor wanted us to use, you can see journal entry 14B, we're going to reclassify that. Actually, let me take that back. It's not from the donor restrictions. What we're doing is we're basically saying, okay, because we signed some sort of contract, so we're taking out of net assets without donor restrictions out of the undesignated and into the designated. Remember, designated and undesignated has to do with board action, has nothing to do with donors. So this has nothing to do with donors telling us what we can and cannot do. This is the board signing a contract, and because monies have been set aside, we're going to basically record them as designated instead of undesignated. These are basically sub-classifications of the net assets without donor restrictions. Journal entry 15, we're collecting a whole bunch of cash. You can see we're collecting pledges. Remember, pledges are unconditional promises to give. The pledges plus some accrued interest, as well as some more investment income, all collected in cash. Journal entry 16A, it looks like we sold an investment. That's basically what happened, and we sold it at a loss. So there was an investment of $85,000, and it looks like we sold it for $59,000. So we sold it at a loss of $26,000. All right, 16B, we bought some more investments. Debit investments, credit cash. Journal entry 17A and 17B. 17A, we are writing off some old pledges that we thought we were going to collect, but we were unable to collect. So we will debit the Contra receivable and credit the receivable. And journal entry 17B, after more analysis, we decided that there was an additional $66,300 in receivables that may not be collectible. So we'll debit the Contra revenue, provision for uncollectible pledges, and credit the Contra receivable, the allowance for uncollectible pledges. Journal entry 18, we're just accruing some interest on our investment portfolio, no big deal there. Journal entry 19, we are basically receiving contributions. $5,000 of the contribution came in the form of cash, and $20,000 came in the form of an unconditional pledge, unconditional promise to give. Journal entry 20, we received a contribution that came with a permanent restriction, and it did not come in the form of cash. We actually received somebody's investment portfolio. So we're debiting the investment and crediting the contribution with donor restrictions. Journal entry 21, it's just a reclassification of expenses. We're basically reclassifying our depreciation and our interest into the different functions: nursing, professional services, general services, and admin services. Journal entry 22 is the closing entry. Closing our revenue accounts with debits. We're going to close our expense and our contra revenue accounts. We will close them with credits. And everything is going to get closed out to net assets without donor restrictions. And then journal entry 23, we're going to close out our basically our revenues with debits and our expenses and contra revenues with credits. And everything's going to get closed out to net assets with donor restrictions. So you see, we basically have multiple closing entries. One to close out without donor restrictions. The second to close out with donor restrictions. And then, of course, the last closing entry is those net asset released accounts. They will also get closed out to the net asset accounts. Remember, these net asset released accounts, they're operating statement accounts just like the revenue and expense accounts. They need to get closed out directly to net assets as well. And those are the main topics in the healthcare organization lecture.